So it's the beginning of 2026, and every year at the beginning of the year, I like to listen to Dr. Lawrence Yun, who is the chief economist at the National Association of Realtors, because he's almost always right, and he does not bring any hype. He just gives the facts and lays it out as he sees it. So I wrote something that I want to read and share with you just because I didn't want to leave out anything in my video about his prediction for the market in 2026. So if you've been wondering whether the U.S. housing market is finally turning a corner, you're not alone. After several challenging years marked by high interest rates, limited inventory, and cautious buyers, many people are asking the same question. Is 2026 the year real estate truly begins to rebound? That would be my question too. Today, I want to break down what one of the most respected housing economists is projecting for 2026, what the data actually shows, and how these trends could impact buyers, sellers, and the overall real estate market in the United States. Dr. Lawrence Yun is the chief economist for the National Association of Realtors. His forecasts are widely followed because they're grounded in hard data, not headlines. He analyzes employment trends, wage growth, mortgage rates, housing supply, and long-term demand to form his outlook. According to his 2026 forecast, existing home sales are expected to rise by roughly 14% nationwide. This is good news, guys. To put that into perspective, the U.S. has experienced historically low transaction volume over the past few years, with sales activity down more than 30% from peak levels in some periods. A 14% increase would signal a meaningful recovery in market activity, even if it's not a return to the frenzy of prior years, which, let's face it, we don't want to go there. One of the biggest drivers behind this projected rebound is mortgage rates. While rates are not expected to return to the 3% range we saw during the pandemic, forecasts suggest they could settle closer to the mid 6% range. That may not sound dramatic, but even a 1% change in rates can significantly impact monthly payments and buyer purchasing power. For many households, this shift alone is enough to move them from waiting on the sidelines back in the market. Another key factor is pent-up demand. Over the last several years, millions of potential buyers delayed purchasing due to affordability challenges. Household formation didn't stop, life didn't stop, but buying decisions were postponed. As rates stabilize and wages continue to rise, many of those buyers are expected to re-enter the market. This includes first-time buyers as well as move-up buyers who delayed selling their current homes. Home prices are also expected to continue increasing, but at a much slower and healthier pace. Projections point to price growth of around 4% in 2026. This is a sharp contrast to the double-digit appreciation seen during the pandemic years. Slower price growth is often a sign of a more balanced market, where prices are supported by real demand rather than speculation or fear of missing out. Inventory remains a major piece of the puzzle. While housing supply has improved compared to recent lows, it is still well below long-term historical averages in many parts of the country. Years of underbuilding have created a structural shortage of homes estimated in the millions nationwide. At the same time, most current homeowners have substantial equity, and foreclosure rates remain extremely low compared to past downturns, which, again, that is good news. That lack of distressed inventory helps keep prices stable and prevents sharp declines. The broader economic backdrop also supports this outlook. Employment levels remain strong, unemployment has stayed relatively low by historical standards, and wage growth has helped offset some affordability pressures. Consumer balance sheets are healthier than they were prior to previous housing corrections, and most homeowners today are not over-leveraged. That said, this forecast isn't without challenges. Affordability will continue to be a concern, especially in high-cost markets. Inventory constraints will vary regionally, meaning some areas may feel competitive while others experience slower absorption. And buyers remain cautious, paying close attention to pricing, condition, and value. So what does this mean for you as a buyer? For many, 2026 could offer more opportunity than the past few years, with more listings coming to the market and slightly improved affordability. However, buyers will still need to be strategic, realistic about budgets, and prepared to act when the right home appears. That means get pre-approved before you start looking. So what does this mean if you're a seller? The data suggests that more buyers may be actively searching in 2026 than we've seen recently. That can be encouraging, but it doesn't eliminate the need for smart pricing and proper preparation. Today's buyers are informed and selective. They can see everything online just like you can. Hello, ChatGPT. And homes that are priced correctly and presented well are still the ones that perform best. The biggest takeaway from this economic outlook is that the housing market appears to be moving towards stability rather than volatility. Not a crash, not a boom, but gradual growth supported by economic fundamentals. National forecasts provide valuable context, but real estate is always local. And individuals' decisions should be based on personal goals, finances, and local market conditions. So, what do you think? Will 2026 be the rebound year that the data suggests? Drop a comment, hit the like button, and subscribe for more real estate insights every week. Bye.